Welcome, everybody. The Perth USAsia Centre, in partnership with Austrade, welcomes you to the second edition of Beyond Delhi. My name is Sonia Arakel. I am a policy fellow at the Centre and lead the Centre's work in India-Australia relations. I'm calling in today from Perth, Western Australia, the land of the Whadjuk people of the Noongar Nation. And I'd like to welcome our audience from all across India and Australia, with a special shout out to those joining us from Las Vegas, Jakarta, and France. Before we dive into today's topic, I'll give you some background on the Beyond Delhi program. The Beyond Delhi program is predicated on the idea that if Australia and India are to build a mutually beneficial economic relationship, we have to understand the major commercial centres, Chennai, Bengaluru, and Mumbai, as well as we do the diplomatic centre of Delhi. So in that vein, today's discussion aims to broaden Australia's understanding of the emerging opportunities in India's economic centres and foster the business and policy links needed to realise them. Today's discussion, we've chosen to ground in the state of Maharashtra. Maharashtra has the highest GDP of any Indian state and accounts for 49% of foreign direct investment going into India. It is also home to some of India's biggest infrastructure projects, including in solar and wind, urban infrastructure and roads. Collectively, these projects are worth $224 billion. Maharashtra's capital, Mumbai, is India's trading and financial hub, whose emergence has been facilitated by a progressive state government instituting economic policy settings. Today's discussion is going to be on the potential of Australian investment, particularly our superfunds, in playing a role in India's development agenda. Now, you might be wondering why a foreign policy think tank is keen to convene a discussion around superannuation and investment. Well, the Australia-India economic relationship has been front and centre for foreign policymakers here in Australia, and the investment relationship is an important part of that. Direct investment can build trust, establish networks, and strengthen business-to-business ties between the two countries. Indeed, an investment-led approach supports the trade negotiations currently underway. Australia is home to the fourth largest pension assets in the world. Both Peter Verghese and Anil Wadhwa, in their bilateral economic strategies, have noted the potential for India as an investment destination for our superfunds. But besides some notable exceptions, such as Australian super, we are yet to put this theory into practice. Indeed, there's an emerging tension between the strategic ambitions of the Australian and Indian governments and the commercial appetite of our superfunds. To unpack this tension, I have with me four incredible speakers. We have Stuart Rees, who is situated in our state of Mumbai, Maharashtra. He is the Senior Trade and Investment Commissioner from Austrade. We have Anita George, the Executive Vice President and Deputy Head of CDPQ, the Quebec's Deposit Investment Fund, who will provide insights into the Canadian experience of investing in India. We have with us Damien Graham, the Chief Investment Officer of Aware Super, Australia's second largest superannuation fund, who will speak to the Australian approach and emerging themes of investment in thinking about India. And finally, Sujoy Bose, the Managing Director and Chief Executive Officer of the National Investment Infrastructure Fund, who will speak to the opportunity in India and address some concerns around risk and return. Stuart, I'll hand over to you to make some opening remarks.
Look, thanks, Sonia. It's really great to be here today. And thanks to you and the Perth USAsia Centre for partnering with Austrade on this Australia-India Business Exchange initiative. I thought I'd start by just noting that in diplomatic terms, the state of the India-Australia relationship is probably at the most positive it's ever been, and it's continuing to mature. And there's a really noticeable deepening of the engagement and trust, and that's really the bedrock for a really sound future. And you could see that just a few weeks ago when Dan Tehan, our Trade and Investment Minister, was in Delhi, meeting not just with the government of India, but also with some of the business leaders at the forum that we had there, where we met with some of the key organisations that are going to be part of and really committed to growing that whole bilateral trade and investment relationship that our countries have together. Now, India is already a major global economic power. It's the world's third largest economy in terms of purchasing power parity. It's the world's third largest construction market. And the country's got a 1.5 US trillion national infrastructure pipeline. So ostensibly making it one of the largest for future, infrastructure investment and partnerships, PPPs or under whatever form. So India offers considerable investment growth and return potential for us. And that's particularly so in the engine rooms of the country. So cities within the states, like where I'm based, Maharashtra, its population of 125 million people, its capital Mumbai, and Mumbai probably sits alongside some other, perhaps even maybe faster growing cities, or equally growing, Bengaluru, Hyderabad, Surat and others. There's actually quite a selection of genuine high growth cities and opportunities within them in India. And from a personal perspective, the pace of change from, say, when I was in India first in 2014 to now is palpable and really quite remarkable. And it seems to be accelerating. It's driven not just by the reforms that have already been implemented in between those periods when I was first returned, and the infrastructure that is rolling out, but also by the aspirations of the country itself that seems to have its own, form of energy behind it. In terms of infrastructure, Maharashtra has got a huge pipeline. And for those that are interested, you can Google a portal called the India Investment Grid. And that'll just highlight some of the major projects in the pipeline. There's about, in US dollars, around 40 billion on roads and bridges, a bit more on railway tracks, 30 billion or so on urban transport projects. And then you've got, ports, airports, energy, and perhaps even, the investment going into the more human touching infrastructure, if you want to, health, education, water, waste and environmental projects that are also in the pipeline, and not necessarily by government as well. In addition to that, you've got the Indian government's asset recycling or asset monetization program. And there'll be a whole raft of opportunities for investors to participate in the more brownfield, operational income producing assets. Now, one of the questions that was posed before I sat down to think about what I'd say was, have governments been overly optimistic about Australian super funds' interest, to invest in India? Now, I don't particularly think so. So as a trade and investment diplomat myself, my answer is no. We are really highly encouraging businesses and funds to deepen the two-way investment relationship because it helps grow both of our economies and, of course, the bilateral relationship. But it is fair to say that we've only really recently started to look a bit deeper at why the funds from Australia aren't quite as active as we assume that they could be. We do know that they are interested and seeking information, and governments on both sides and agencies on both sides have got a role to play in that, and we are playing that role. But there has been a bit of a temptation to look at the commitments, say, of the Canadian pension funds, for instance, and ask, well, why, if they are doing it, why aren't Australian funds? I mean, we're kind of alike, aren't we? But it's not quite that simple. There are some pretty significant differences in how funds in Australia and Canada operate, particularly within their home countries. And that drives some of the investment behaviour overseas. Now, Anita and Damien will be able to give much more depth to this than I can. But one of the differences that I see is the competitive environment within which funds operate at home. And, in the Australian sense, the savings that funds manage in Australia are far more mobile. And that mobility between funds is likely to increase thanks to the annual benchmarking publication by APRA. They're also defined contribution funds, not defined benefit schemes. So it means the funds need not just high returns, but the ability to redeem quicker, and put cash in the hands or, and transfer funds between, members' savings between funds, should they wish to. So this does flow through to the type of investments that funds are typically seeking. So there is a bit of a tendency to avoid the long-term or liquid projects. It also means that, because of the competition that is there in Australia, funds are running pretty lean machines to keep the costs down. So building up teams to manage different complexities of new markets when they are structured to, say, an OECD-like operational environment does tend to put, emerging countries down the list of where they invest. And I think when you add, for example, a bit more complexity and the risks inherent with greenfield infrastructure in unknown markets, the Australian funds typically don't have the in-house skills to manage. So you do see, I guess, a little bit of a mismatch. But what I don't want to do is actually dwell on complexities, because I think overly dwelling on those complexities is actually a bit of what's standing in the way of investment commitments being made. Funds are interested, but I think they also need to play a bit of a role in helping guide the structuring of the investment vehicles in which they could be interested in, so that they are more comfortable with the risks in India's emerging markets while remaining competitive enough to secure quality investment opportunities. And this last point about the quality investment opportunities, I feel, is important, because if you want a good return on a high quality asset, you're going to be in competition with others. It's not going to automatically fall in your lap. It is a competitive space in India. And now, I've deliberately mentioned emerging market, and I guess playing the role of a protagonist a little bit here. I think India shouldn't be generalised away like that, nor just be seen as sitting within an emerging market index. There are some key differences between India as an emerging market and a whole raft of other emerging markets. What needs to happen around India is that it needs to be judged by its operating environment of the here and now, a really contemporary view of it. And I'm sure Surjoy is going to be able to highlight some of the regulatory changes of late that have been made in India to make the investment environment more attractive. And I guess he might also want to, challenge me on whether funds, should be, looking at India and trying to think about it as an OECD-esque operating environment, or wanting to change it into that, versus what actually India can offer as it is now, as an emerging market within the existing conditions it offers. So I think for us, helping funds maintain a current view of India, such as we're doing today, is a really valuable thing to do. Most of them, if not all, have a lot to learn about India. And I guess what better way to hear from the operators themselves. So at this point, Sonia, I think I'll hand over to Anita George from Quebec's investment fund, and look forward to some of the Q&A afterwards. Thank you.
Thank you, Stuart. Good morning, good afternoon to everyone and my fellow panelists here. It's a pleasure to be here and to speak about Canada's experience. So all or most, I would say, of the Canadian pension funds have been investing in India over the past 5 to 7 years, and using, in fact, different models. So that's something also interesting to talk about. Collectively, we've invested about $50 billion in India over that 7-year period, and across different sectors. So let me start by just giving our own experience of CDPQ. We are Caisse des dépôts et placements du Québec, Quebec's pension fund, and Canada's second largest pension fund, with about $360 billion under management. And we actually invest across different sectors, ranging from the most liquid fixed income and listed equities to the real sectors through private equity, infrastructure, as well as real estate. And in most of our asset classes, we invest both directly as well as through funds. The exception is infrastructure, where we, I would say, almost always invest directly and not through funds. And in terms of our investments in India, we opened our office in India, in Delhi, in 2016. We are a team today of about 20 people, and we cover all of the 5 asset classes and work very closely with our asset class team. We have a hub in Singapore where we have the heads of the different asset classes for at least the major ones who are located there. And the way in which we look at India is really from a global perspective now. We have a group called CDPQ Mundial or CDPQ Global, which is all the geographies outside of Canada. So India is in fact placed similar to Europe, the US, while there are, as you mentioned, Stuart, ways in which we do focus on emerging markets, and we report also our returns and our performance on the basis of emerging markets as a geographic group. But in terms of the approach and the asset allocation, it's really country by country for all countries outside of Canada. And in that perspective, India holds an important place. In fact, we are overweight on India in that we have more exposure to India than the MSCI index. And we've invested about 7 billion Canadian dollars in India. To give you a quick overview, it's very well spread out. So we have investments in each of the asset classes that I've mentioned. And from a sectoral perspective, we have investments in financial sector, in infrastructure, in real estate, in fixed income, which is across sector agnostic, as well as in the stock market. And one of the recent trends which we are seeing in our investments in India is the area of technology. So we've done direct investments in mostly SaaS businesses, B2B businesses, in the, I would say, private equity space, as well as in the venture capital space. And here we've operated both through local funds as well as global funds that are focused in these areas, as well as directly identifying either co-investment opportunities along with our fund GPs or through our private equity direct investments. We've done some technology investments, and that's a growing trend. So I'll stop there and hand over to Sujoy.
We might go to Damien next, actually, and we'll wrap up with Sujoy. But thank you, Anita. Damien, I'm interested for you to reflect on some of the mismatch comments from Stuart, how the different approaches that Anita has taken as well on direct investment versus through funds, and the differences between the Canadian and Australian operating environments.
Thanks, Sonia, and fascinating. Thanks, Stuart and Anita, for those comments. And I think it really does resonate very well with what I was going to touch on. But I might just give 2 seconds on Aware Super as an introduction. So just for those who in the audience who don't know our fund, and I think, Sonia, you mentioned we're one of the largest funds in Australia. That's true, with about 155 or so billion dollars, which is large by Australian standards, but not large globally, and certainly smaller than some of the Canadian funds and some of the offshore funds as well. So, but we have a little bit more than 1 million members, and traditionally we have provided our pension services or savings to public sector workers in some of the states in Australia. And more recently, with the merger with WA Super, we now have quite a lot of members in WA as well, which is fantastic. And I think Stuart was very correct in saying that we are a defined contribution fund. Our members obviously are not locked in like a defined benefit, but I wouldn't quite characterise the liquidity issue that Stuart mentioned as being correct. We do have lots and lots of long dated assets, and we feel that that's a really critical part of investing and driving the long-term outcomes for our members. Most of our members will be with us for 20, 30 and even 40 years plus. So we have a strong focus on making sure we can invest for the long term as well. It's been interesting, just touching on India more specifically though. That's an area that I've had strong interest in over the last few years. And again, I remember meeting Sujoy in India a few years ago. And it really comes down to the opportunity set that any investor has, and the Australian funds are good examples of that. And I think a level of sophistication and resourcing as well. So it was interesting listening to Anita and the growth from CDPQ's perspective in what they're doing in India. And that really reflects something that I think is critically important for any investor when thinking about where to invest. We have a very, very simple rule, which we always test: can we make money as a minority investor in a new region? And that's a critical question that we ask ourselves. And it really reflects the fact that we need to have the right relationships, we need to have the right resources, we need to have the right boots on the ground effectively, where we're moving into a new area, to make sure we can have confidence that we can understand that local market and really deal with the asymmetry of information, because we know that anytime we move into a new market, we'll be dealing with people that have been in that market for a very long period of time, and they may have much better local knowledge and better understanding of the laws, the regulations, the opportunity set, how to really maximize the investment dollar there. So that's a lens we take to all markets we look to invest in, and certainly India is no different than that. We haven't made direct investments in India. We've had a few near misses. We have some liquid investments, some listed investments, but we haven't gone down the path of allocating significantly to India from a private market perspective. And it comes back to that issue of making sure that we feel we've got the right level of resourcing and relationships at the right time, and local understanding as well. So we would very much reflect on what Anita highlighted around CDPQ, that we would suggest that having that local presence and having an office in, whether it's Delhi or Mumbai or both, is critically important to really being successful in making that long-term decision and commitment to India. And we haven't, as a fund, got to that perspective yet. We're really just starting our offshore expansion. And I think that, again, just really reflects the different level of maturity for some of the Australian funds versus the Canadians, which have probably been global investors and global direct investors for 5, 10, 20 years. So I do think there's a little bit of a difference there. We're wanting to ensure that we don't, we fully understand, or we understand as much as possible before we step into any market, whether it's India, whether it's China, whether it's Brazil. They're all got their own idiosyncratic outcomes. So that's critically important to remember. But I think the thing that has attracted me to India over the long term, and certainly more recently when I've been there, is just the energy and the opportunity that clearly is there. And so from my perspective, I feel like Australian funds, whether it's Aware Super or other funds, it's more likely a when, not an if, that we'll be more materially investing in India. And that goes for other regions as well. But I do think there's a great opportunity set for all the things I'm sure we'll talk about today, whether it's the strong reform agenda, whether it's the demographic tailwind that India has that other countries don't have as much of. And I'm sure that's some of the themes and tailwinds that have really supported activity from Anita's fund or other funds to have great success there. What I would say though, and again, that every market has their unusual idiosyncratic perspectives, and I think India has those as well. So that's why I think that local knowledge is critically important and local relationships are critically important for success. I might stop there, Sonia, but very happy to take any questions. And again, really appreciate the opportunity to talk to the audience today.
Thanks, Damien. And I think you've really reflected some of those pain points that I look forward to discussing with all the participants. But for now, Sujoy, interested to hear your opening remarks.
Thank you, Sonia. And you asked me to focus a little bit of my opening remarks on Maharashtra and the Indian reforms. I'll come to that, but I'm going to start actually by doing two things. First is, the way Damien put it really well. When they look at coming into a new market, what he said is what they look for is, can they make money as a minority investor in that market? And I'm going to pick on that and talk a little bit about NIIF, because I think this is a crucial, I think it's a part of the reform by the government to actually attract capital from international investors who don't know India as well as some others. And NIIF, which is where I work, the National Investment and Infrastructure Fund, is actually like a PPP, a public-private partnership between the government and international and domestic institutional investors. We are owned 49% by the government as a manager of, as an asset manager, and 51% by commercial investors, both from India as well as abroad. And by the way, Aussie Super owns almost, it actually owns more than 10% of the manager. So that itself gives you kind of a sense that of the credibility and the potential that we have of Australian investors coming in through us. We are an asset manager operating in really two asset classes. One is infrastructure, and we manage India's largest infrastructure fund. And we do everything that I think Anita and Damien said that they like to see, which is we focus mostly on operating infrastructure assets. We operate on a co-invest, on a fund investment plus co-investment basis. So we understand very well the pension funds, the sovereign funds, etc., around the world. And we created a product to actually benefit their or fit into the way that they think. We focus a lot on governance. We focus on environment and social principles. I come from, Anita and I used to be colleagues in the IFC, which actually set the Equator principles when it comes to ESG. So we have adopted those kinds of practices in NIIF, and we operate with a fully commercial incentivized. The team is incentivized actually to and is aligned with the investors to actually make money for them. So on the infrastructure side, we have investments of close to, at the enterprise level, close to $2.5 billion now. And these are, so we own, for example, India's second largest logistics, rail-based logistics platform. We own control stake in one of the fastest growing renewables companies in the country. We are focusing on a very interesting platform that will install smart meters, will convert the traditional electricity meters in the country to smart meters, and so on, roads, etc. But we also do private equity, and that's the second aspect of our business. But private equity with a difference. I mean, private equity where we are actually focusing on crucial sectors of the country. So we are the second largest shareholder of the second largest hospital chain in the country. Extremely well reputed, and a chain that is actually very well positioned for growth. We own a control stake in one of the largest non-banking finance companies that finances infrastructure, and we can do both operating infrastructure as well as financing greenfield infrastructure through that platform. We are now talking to foreign investors to come and take stakes directly in that platform. So the idea is that we have created a fund manager that understands foreign investors and creates opportunities for them not only to invest through the fund, but also then to come in directly, right, as those platforms grow. So that's in a nutshell NIIF, and that's the first thing I wanted to respond to. Damien, thank you for giving me the lead into that. And the second thing that I want to focus on is actually to demonstrate a little bit what the Australian investors are actually missing out on in perhaps what's the largest infrastructure market outside brownfield, I would say operating and brownfield infrastructure market outside of OECD. And that is, of course, why the Canadian funds are here. And I mean, Anita already spoke about her fund, but I know that there are other funds that are extremely, well established in the country, but also have very large exposures in the infrastructure sector in India. So just to give you a sense, and this is where, Sonia, I'm going to start with the Maharashtra story. So, Maharashtra, if you look at Mumbai, which is the largest city, right, population of 25 million, one of the largest economic hubs in the country, perhaps one of the largest economic hubs in Asia. Just to give you a sense, the airport, the Mumbai airport, is a private airport. It was actually, it has been privatized for almost 10 years. It's in private hands. Pre-COVID, it had 45 million passengers. And it was growing at about, and literally it was not growing because it had capacity constraints, but the airline traffic in the country was growing at 17%, which was one of the fastest growing large civil aviation sectors anywhere in the world. And we were at almost 100 million passengers going to 150. Actually, we're at 120 million passengers going to 150. And the return of domestic travel, which I'm sure you're seeing in other parts of the world, has been quite sharp. International travel is still a problem, but domestic travel has returned more or less. At least whatever slots are being utilized by the airlines are all full. The port terminal, again, it's in private hands. In fact, our partner owns 2 of the terminals in Mumbai port, 5 million container TEUs a year. And again, growing rapidly, EXIM traffic growing, the connectivity to the land on the rail side is a challenge in India, and that's where we are investing a lot of capital. And then we go beyond Mumbai, right? Pune is basically the automobile capital of India. And Pune, which is one of the other cities, accounts for almost 35% of the automobile production in the country. And by the way, Pune doesn't yet have its own airport. Pune is serviced by Mumbai Airport. So just to give you a sense of the opportunity that awaits, right? You hear so much about pharmaceuticals in India, right? Maharashtra is, again, production facilities in Maharashtra account for a very large share of the pharmaceutical industry capacity in the country. And it's beyond Mumbai and Pune. We are talking about cities like Nashik, which many of you probably haven't heard of, Aurangabad, and so on. By the way, Nashik also happens to be the wine capital of India, and a lot of the grapes actually come from Australia and New Zealand. So we are actually bringing good stuff from Australia and actually setting up interesting industries here. Food processing, Maharashtra, again, Nagpur is a city you guys may have heard of, 3rd largest city in the state. It is a hub for several, I would say, export-oriented, high-margin crops, such as not just pulses, but also grapes, bananas, sugarcane, cashew nuts, these kinds of crops. So, and by the way, what does this mean? So this means that in Maharashtra, and coming back to the infrastructure sector, we have some of the largest infrastructure projects in the country. So there is a expressway being built between Nagpur and Mumbai, which is about a $7 billion project. It's being built by the government, but guess what? It's going to be monetized and privatized at some point post-construction, right? Mumbai itself, by the way, there's a ring road being built around Pune. Mumbai itself has 3 very large projects, actually 4 very large projects that are going on. There is a coastal road being built connecting South and North Mumbai, which is like the JFK in New York City. There is so there's a new airport being built, a greenfield airport that is being built. That the concession was won again by the private company that owns the existing Mumbai airport. So imagine the growth over there. And by the way, there are 4 metro lines being built in the city. So in another 5 years, Mumbai, so many of you who visited Mumbai and have been exasperated by the traffic over here, I'd love you guys to visit again in 5 years. I think you'll see a completely different city. So that's really what's Maharashtra all about. Maybe, Sonia, for the benefit of time, I'll stop here. I'm sure we'll have a chance to get into the reforms at the national level a bit later.
No, fantastic, Sujoy, and thank you so much for really grounding the discussion in our theme of Beyond Delhi and looking at cities like Pune and looking even outside of the main centre of Mumbai and into other growing areas that the Australian audience may not be familiar with. I really appreciate that. But I am going to ask you to go back to Delhi and answer one of the questions that our audience members have asked, which is, how well do India's regulatory settings and tax structures actually support especially super fund investments? What kind of regulatory reforms have there been recently that are important for Australian institutional investors to know about?
Sure. So look, again, I know that the supers are very keen on the infrastructure sector, so perhaps I'm just going to start there, but I'll go into some other areas which I think are crucial for investors to understand about India. So first of all, the regulatory framework in India is not bad at all. So any ranking you look at, the regulations in India on the infrastructure side actually stack up pretty well. vis-a-vis many other countries. Whether you look at World Bank rankings, whether you look at EIU rankings, any other sort of global rankings. The issue is not really, in my opinion, the issue is not really on the regulations per se. The issue is dealing with counterparties at the actual, the level of the actual projects. So when, one of the areas that India is actually pushing forward on is on independent regulators. So not all regulators are independent. So you can have the best regulations in the world, but if the regulators are not independent, there is an issue with the implementation of those regulations, right? So that's one area India is pushing forward very hard. The other area is actually offtake risk, counterparty risk. And that is where, because you can have the best PPA in the world, but if your counterparty is not financially competent to actually pay you based on the PPA, you have problems, right? And even if you have a great regulatory framework, I mean, this is your PPA, right? What do you do if you're not getting paid? And that's where, like Damien and Anita both said, boots on the ground, understanding, having the right partners, understanding which are the discoms, which are the utilities that you can deal with, which are the utilities you have to be careful about, crucial, right? So in my mind, so what I'm trying to say is that I don't think the regulations are the issue. It's the nitty gritties, the details that are more important. And people like us, people like Anita and her partners who are in India, who are dealing with these issues, we are dealing with them. We have, Anita and I can tell you stories about infrastructure investments that we had made in our previous lives that are returning serious levels of returns. Why? And that's the second part.
Right.
I think for India, I think the investors need to understand that it's not just a pure regulated monopoly yield kind of play. There is an added advantage of growth. And it's very unlike many of the large stabilized markets that these investors are sort of used to. But I think that growth, so in an airport, when you come in, it's not just about the regulatory aspects that you're looking at, you're also looking at a demand that is growing at 17% a year because supply is constrained, right? So it's a very different way of looking at things, and what's driving that, and that's really, is that being driven by short-term commodity price increases or capital flows? No. And that's where India is very different from other markets. In India, it's being driven by fundamental reform. And if you look at what's been happening over the last good 10 years, we've gone from about 33% of the population being banked to 80% of the population being banked. And it's been done in a very simple manner by connecting mobile phones with bank accounts and a unique identification number. We did not have a unique identification number a few years back. Now we do. And when you connect the three, financial transactions become really simple. You can build a rating system. So that kind of stuff. A value-added tax, a national, etc. So there have been fundamental reforms that have led to growth in the number of people who can participate in a formalized economy. And then there's encouragement to formalize, because in a value-added tax, you actually have an incentive to get the supplier formalized, right? Because everybody through the chain gets an incentive in that value-added tax system. Hence, what's happening, and that's what you see in India, a lot of formalization of the informal economy, and I think that's fantastic for the country. Great, I could go on. There's so many things that have been done, but I'll stop there.
So Joy, I want to hear more about those stories that you said that Anita and you could tell us about investments that you made many years ago that have now changed. Anita, we have a few questions from the audience around looking at the strategy going into an emerging market like India, and especially taking into consideration weighing up greenfield versus brownfield opportunities, whether things like stress sectors and distressed debt is a part of your India thinking.
Thank you, Sonia. So I could actually tell one of the stories that Sujoy referred to. When we were together in IFC, we actually invested in the first commercial megawatt of solar in India in 2009. And that company grew to about 1,000 megawatts, at which time CDPQ invested in the same company, which is Azure Global Power. And today it's at 7,000 megawatts, and it has made 30% dollar return for the IFC investment that we made. And one of the things to stress is that coming into the sector when the regulations were still evolving was a chance that we could take as a development institution. As a pension fund, when we came into Azure, initially as a minority shareholder in a listed company, our intent was really to understand the sector and to learn more about the sector. And that you can only do in some ways once you have an investment, you have the understanding of all the nitty-gritty that happens on the ground, and we've learned a lot from that. And also how to mitigate some of the obvious risks like state electricity boards which are not very strong, etc. How do you structure your transactions in a way that helps you address those risks, I would say upfront, and like taking the bull by the horns. So that was one part of the story. The second that I would say is you asked about brownfield versus greenfield. So when we came into that platform, it already had existing brownfield assets with a track record of several years, as long as I think between 5 and 7 years. So it was easy for us to evaluate, to understand the risk return profile. However, once we have been invested and now CDPQ is the majority shareholder in that platform, we are also bidding for greenfield projects. So it's been a process where we've gotten comfortable with the sector, with the regulations, with the competition, with the nitty-gritty of actually projects on the ground, and the team that we have in this platform. And then once we had that confidence, we've been able to now expand into greenfield projects. So that's the kind of process. In the road sector, where we were still looking to see how we could invest, we created actually a platform which is owned 100% by CDPQ, and we are aggregating brownfield assets. My hope is that once we've done that, we would be then creating, firstly, a very good road company in the Indian infrastructure sector, but also being able to then bid for greenfield projects as we've understood the sector, etc. So that's the approach that we are now taking, and that has proven to be one which is working well. As part of the regulations, one of the things that we, since we invest a lot as CDPQ in Australia as well, we actually did a comparative analysis of all our infrastructure investments, and we found that in India, one of the challenges was the high level of taxation as well as the complexity of taxation. So along with Sujoy and NIIF, we made a case that for long-term institutional investors who are best suited as infrastructure investors, the government should consider giving a tax exemption. And the government did do so in the finance bill of 2021. And the pension funds as well as sovereign wealth funds have been exempted, which then makes India an even more attractive opportunity, because it's not just the straight benefit to your bottom line from lower taxes, but it's also the hassle factor of not having to worry about which tax you're eligible for to pay and what you can get an exemption of, etc., etc. So that simplicity, I think, has also helped us a lot. And my hope is that with the 1.4 trillion pipeline that Stuart mentioned, that there would be a lot of good opportunities in the infrastructure sector. But I cannot underscore how important it is to know the sector, to know the players, to know the regulation before you jump in.
Great, thank you, Anita. And I think it's some really interesting comments there, especially about how, as a fund, you had an opportunity to influence the regulatory environment as you were establishing there and being a part of the legislative journey, and how that benefits the fund and ultimately your members. Damien, I'm interested to hear, you know, if we were to believe Sujoy and Anita, then it's opportunity that can't be missed. So I'm interested in your perspective, especially because I know your investment pool has doubled since 2016, and you're preparing to invest more than 250 billion over the next few years. And India is not the only option. There we have rapidly emerging partners in other nations in the Indo-Pacific, maybe that you don't need to be a part of the regulatory journeys for. So I'm interested for you to reflect on what Sujoy has said, firstly, and then secondly, if you could also let us know, as you're planning your investment strategy for the next few years, how geopolitical tensions, especially in the context of Australia's emerging dynamic with China, factor into how you think about where you invest your funds and what returns your members will be getting and how they'll feel about those returns into the future.
Yeah, thank you. And there's a lot there, so I'll try to respond. But I think Sujoy and Anita certainly both highlight a lot of the positives and a lot of the tailwinds that I think are very relevant in India. So as I mentioned in my sort of initial comments, I believe that India is a when, not an if for most global investors and Australian super funds as they get larger. But I do think we need to make sure we've got the eyes wide open and understand the complexity. And that's where, again, I think Sujoy highlights the work that NIIF's doing to really help to bring foreign capital into India. And I think that's fantastic. It's been interesting in our journey to think about where we want to take risks. And that conversation around the brownfield and greenfield is really interesting to me because when you look at a broad, diversified portfolio, you are certainly trying to diversify the risks you take. One of the things that we've been focused on is taking more complexity into our portfolio in different regions, different types of assets, not just buying mature toll road or mature airport, but how do we develop these assets to create value? And knowing the local market and being deep in the understanding of the local regulations and the opportunity set's critical. So that's just a maturity factor for us. And I think what it highlights is that as we look to broaden out that type of experience and exposure, as we do it overseas, and we've started to do that in Europe, but as we start to do it in different regions such as India, we'll just look at how we need to resource that and how we need to make sure we've got that local understanding. So as I said, I think it's a when, not an if, but I'd suggest it'll take a little bit more time. And unfortunately, Anita's probably a few years ahead of us with regard to the platform that's been set up in India for CDPQ. With regard to global geopolitical issues, I think it's always relevant to understand how you're going to operate. And again, it goes back to the question I posed at the start. How do you have confidence that you can create value in those regions? And really that you need to have as much stability in what's happening from a regulatory perspective, geopolitics, et cetera, to make sure that you can access that investment or access those funds when you need them, if you want to. And that's where I think India is clearly, the reform agenda is pushing forward to ensure that there's that confidence. We've been a direct investor in China for a few years now. We're the first Australian fund to have a QFII license in China for A shares. And that's been a really interesting journey. Again, I think to Anita's point earlier, you can't replace those lessons if you're not directly involved. And we've certainly learned some lessons in China that I'm sure we'd learn in India when and if we get to that same position. So, but we reflect on the geopolitics of China and make sure that we're understanding as much of the risks of investing in any country. So that's relevant for our Chinese exposure, but obviously would be relevant for India if we broaden it out apart from just our listed exposure that we have today.
Interesting. And everyone's talked about the importance of boots on the ground. Stuart, you are on the ground. I'm interested in your reflections on what the panelists have said already and the role that the Austrade plays in providing the insight that we know is so crucial to a successful investment, whether it's superannuation or other institutional investors.
Yeah, look, nothing beats, presence on the ground, you know, for supporting trade as well as investment. And that's why we've got 7 different physical locations across South Asia at Austrade. We have about 50, locally engaged different sectoral specialists based in different posts across South Asia. And of course, the biggest majority of them by far are in India. I think, what we've done in the past and continue to do, and actually building up resources to do, is actually provide that sort of on the ground, deeper sectoral knowledge than is possible than doing it third hand from a remote location anywhere. And from time to time, we do have some pretty forthright discussions with investors as well as exporters and importers also about what are the realities of the ground. What is known about this sector, what is known about the the customer, the buyer, or the investor, to help people sort of cut through and I guess save a bit of time and zero in on the things that they ought to be focusing on. Look, so we've got that network, and we can certainly support that understanding of the ground. In the investment space, Austrade as an agency probably does focus more on the FDI investment, attracting investment into Australia, and we've got a really interesting pipeline actually coming through that goes well beyond that sort of traditional IT services sector into some of the emerging things, hydrogen, renewable energy, electric mobility. India has the capacity to be really innovative in a number of sectors. And I think one of the questions you're going to ask me was about, unicorns and so forth. Well, nobody's producing, well, the USA is the only country that's producing more unicorns than us than India. At the moment, it is a really interesting place. And I think, those type of emerging companies, and I guess the Soonicorns, are also interesting, for companies, investors to keep an eye out for. And, we are focused on building up a far stronger team now, Bengaluru post, which is, Bangalore is the IT hub, the innovation hub of India, and anything in those digital spaces is super interesting. Education, health, fintech, reaching the next 500 million. That's the size of the new market yet to be tapped in India. It's super exciting.
It is, and I'm glad that you plugged Bengaluru, because that will be the location of our next Beyond Delhi series, where we will be focusing on e-gaming and the relationship between Australia's gaming industry and the emerging market in India, and specifically Bangalore as the Silicon Valley of India. Before we finish up, Anita, I'm also interested in your reflections based on what Damien said about how he thinks geopolitical tensions will affect the super fund's long-term strategy around where companies choose to invest within Asia. How have Canadian super funds been thinking about it as compared to Australian funds?
So I think geopolitical risks, in fact, within our risk department, we have a team of about 5 people who are focused on geopolitical risks. So this is not something new for us, and actually it's something that we expect will continue to be a challenge in this sort of global investing universe that we operate in. So the way we look at it, when we are evolving our country's strategies, we do look at geopolitical risks. And in fact, ironically, for China, as well as India, as well as Brazil, we had done this kind of an evaluation. And based on that, we said that we should really focus at companies that are not easily prey to their performance being affected by geopolitical tensions. So just in terms of strategic direction, those have been informed by our own in-house geopolitical assessment. We also, in say China, for example, we've stayed mostly in the liquid investments or through funds. And we've selected very good partners who've held us actually in good stead. And again, I underscore the importance of picking the right partners. And similarly, in India, we have followed the same approach. Look at industries and sectors that are not unduly vulnerable to geopolitical tensions, either regional or global, and look at partners who can help you understand those tensions and also, no matter what, can address those tensions. Some of the things that we're seeing, like the diversification of the supply chain, especially post-COVID, that is bringing up opportunities for us in countries like in the Southeast Asia region, so Indonesia, Vietnam, as well as India. And we are taking advantage of that because we feel that it's good to have a more diversified supply chain globally. And we are also looking at, the whole trend and the sort of movement of more and more capital towards sustainable investments. And this has been something which is very core to CDPQ. In fact, we were founding members of the Principles of Responsible Investment. And we've continued through the years to have very specific targets for reducing our carbon intensity as well as creating new green investments. And we followed that strategy as well in the emerging markets. In fact, I would say that our renewable investments, the recent growth that we've seen is a lot in the emerging markets.
Great, thank you, Anita. Damien, before I throw to Sujoy to make some closing remarks, I'm interested, and so is Stefan, who's one of our audience members, to understand how you think whether your China and India approach are similar, what differences they might have, and yeah, you're thinking around that.
Yeah, I think, thanks, Sonia, thanks for the question. Certainly, I think it comes back to that core question I mentioned earlier, which again, it's interesting, Anita's comment on geopolitics or geopolitical risk. It wraps it up in the same way. Geopolitics can certainly be one factor that can reduce our confidence in being able to generate a good return in a country. Certainly, and I think Sujoy made a very, very strong comment, which I think is absolutely at the core of that. How strong are your counterparties? How do you rely on those different counterparties to pay you back when you expect to? So, it all goes to the same sort of question. So we do believe that there's a lot of positives that align to India and China with regard to the size of the market opportunity, clearly, the size of spend around some of the key sectors. And it really resonated with me, Anita, around your sectoral discussion as well, because, for China, for instance, we think that health is one theme that we are quite interested in. So that's an area that we are quite interested in investing in. We are investing more money into that area. But we wouldn't do it more broadly, or there are some sectors we wouldn't focus on because we do think there's more risk around that. And that would be relevant to India and China as well. So it is really about doing the work, understanding the opportunity set, not doing investing broadly, but really being quite targeted. And I think also ensuring that you do have the good relationships and also resources to support that. And it may be resources in market if that's important. And I think for some of the markets we're talking about, whether it's India, whether it's China, whether it's Brazil, other markets, having those boots on the ground is really important.
Thank you, Damien. I think it's really interesting how changing geopolitical environment is changing your risk assessments, and also how it might affect members and how they see about where their money is going. If there are different countries that fall on different sides of a conflict, how they might feel about having their money going towards these markets. And that will be a challenge for our future, not for now, thank goodness. But before we wrap up, Sujoy, I'll ask you to close with a few remarks reflecting on what we've discussed so far.
Thank you, Sonia. I think it's been a great discussion covering so many different aspects, and also I think having Damien's perspectives on what Australian super funds are looking for is also very useful for me, and I'm sure for my colleagues. I wanted to make literally 3 points, right? First is that pre-COVID, we were actually very excited to see a lot of visits from Australian super fund teams to India. And I think we were on the cusp of breakthroughs of more investment coming in from Australia into India. And then unfortunately, we had COVID and all priorities changed at that point of time. So I think the momentum was there and there was a break. But what I want to point out is that I think the next 3 to 5 years in India is going to be very exciting. And a lot of reform has been done, which several of us have spoken about. I think the next leg of the government's program is actually going to be monetization of assets, whether it be privatization or concessions and so on. And I think Air India, the Air India privatization is a very important milestone. It shows the intent of the government to cut through bureaucracy, to cut through a lot of other issues to get things done. And I think, so you probably know that the government has an asset monetization program, as it's called, of $80 billion over the next 3 to 4 years. And I think a lot of those assets are going to be quite interesting for investors such as the super funds. And I think for that, Damien mentioned it, Anita mentioned it, I mentioned it. I think the key for foreign investors is their local partners. So even if you look at the Canadian pension funds, Anita's fund, CDPQ, started by investing through partners. That was what it was 5 years ago when I first, when I came here and I started to see what the Canadians were doing. And it's only recently, over the last, I would say, year, that they've started doing direct investments. And I would encourage the Australian super funds to think along those lines, which is really but it's very important to find the right partners, right? Not to go with the wrong partners, because then you have a bad experience and that sets you back years, right? Find the right partners. We are there. Whether you want an investment partner or just a sounding board to help you guys, please reach out and we will be delighted to be a part of that journey for each of you. So thank you, Sonia. I really appreciate the sort of this event and also, the invitation to join it. Thank you.
Thank you, Sujoy, and thank you, Anita, Damien, and Stuart. We've really enjoyed this discussion. I must admit, a lot of it did go over my head as a foreign policy expert, but I am looking forward to writing an analysis piece on what you've all discussed and taking this conversation outside of this webinar as our colleagues at Austrade will as co-hosts, and turning this community around this issue into some outcomes that benefit both Australians and Indians. Thank you all for joining us, and we'll see you next time where we go to Karnataka and Bengaluru to talk about e-gaming and the opportunities there are there. So thank you again, Anita, Damien, Sujoy, and Stuart.